Hey everybody. I had a fail that was ready for this week, but I just recently came across another one that I'm going to move into this position this week, simply because it's good timing for this. It's a very recent interview. This retirement fail will absolutely butcher your net worth if you aren't careful. It's listening to the wrong people. I normally don't listen to these mainstream finance shows. This one came to my attention. It really irked me. I wanted to comment on it. Just a few days ago, at the end of June 2026, the legendary investor and billionaire Jeremy Grantham went on the CNBC's Squawk box. He threw a massive hand grenade into the financial media. He declared that we are living in the single most expensive market in American history. And he warned everyone to completely avoid US stocks and hinted at a potential 70% market crash led by the AI bubble. You know, once in a while they get these guys on here, just I think for headline news, but I'm going to share a few key excerpts of the interview, and I really recommend you listening to it, more for the sake that the host actually pushed back. You know, and the funny thing was about this interview is that most hosts just let the big-winded know-it-alls just talk and they give no pushback. But this time, the host, I think his name is Joe, he not only called this guy's BS out, but he also challenged him with some hard facts. And you'll see the wind talker stunned. He can't even respond. And at one point, if I had good pixels on my monitor, I think the guy went tomato red. He was furious that he was called out like this. I really recommend you watching it, but I'm going to show you some of the excerpts that I enjoyed from this particular interview.
Our next market guest is a legend. He's got a long history of calling bubbles, and I think you're worried about all that grease, maybe. We'll see. Jeremy Grantham is here. He's the co-founder and long-term investment strategist of GMO, an asset management firm with $85 billion in assets under management, and he is the author of Making of a Perma-Bear. We're cooking with gas, apparently, or with grease. And the question is, are we in a bubble? Are we not in a bubble? Are we always in a bubble?
We needed a definition of a bubble, a nerdy statistical term, 2 sigma.
That it has paid shockingly well to be a perma-bull over the last 100 years, more than it has paid to be a perma-bear.
Oh, of course. We live in a rising economy in the long run. But half the time you're waiting to get back to the old high. People don't realize that because we've just spent the last, whatever it is, 16 years going up. But in the long run, it's half the time. After 1929, you have to wait until 1954. After 1972, you have to wait until 80, a long time.
81 or 82. Yeah. And so where are we now then? What's a comparable to you?
In a very real sense, I'm not sure there is a comparable, but the tech bubble of 2000 would come the closest. This is the most expensive market in American history.
Does that mean that it's overvalued and has to go down from here? Or is it possible they could continue to go up for many more years?
Sometime between 2 weeks ago, 2 weeks from now, 2 months, 2 quarters, and conceivably 2 years. And getting back to trend from here is closer to a 70% decline than a 50% decline.
A 70% decline, you think, is in order?
Yes, I do.
What was in 2021 and 2022? What was your super bubble call? And that predicted an imminent catastrophe, crash across stocks, bonds, real estate, commodities, and stocks. Another one in 2023, another collapse. Super bubble.
The only 2 times I clearly said it's now.
Through the 2010s, were you ever bullish through that entire period?
2009, almost there. From 2010 until today, the PE has averaged over 60% higher than it did for the prior 100 years.
You know, the most dangerous words in economics is this time different. Are we in a moment now, though, where the technology fundamentally is different, and it fundamentally is going to rewrite the rules of investing and valuations and everything else?
Internet, a huge invention, changed everybody's life. They were always accompanied by overinvestment and temporary collapse, out of which the railroads changed the world, the internet changes the world. This is exactly the case today. AI is so obviously a dazzlingly important idea. Everybody knows it, don't they?
Yep.
We all know it, and therefore we all want to put our money in it, don't we? Mm-hmm. So we all put our money in it, and it sucks in more than you can shake a stick at, and you get overinvestment. So everyone, in the end, in those situations, loses their shirt. They lost their shirts in the railroad. Brilliant idea. They lost their shirts in the internet. These are the 3 great ideas of the last 200 years, and they will lose their shirts in AI. We're either going to be sitting on the beach getting served mint juleps by machines, or they're going to kill us, accidentally or on purpose.
You're going to be wrong on everything you've
Proof of unnecessary work shouldn't be worth a bucket of warm spit, and it will not be.
All right. It's only been 20 years so far, so someday you might be right about that.
The point is, it hasn't outlived a general bull market. We've been in a bull market since March of '09.
Right.
And when we get into a bear market, which Joe may think we never will be again, a serious bear market of down 50, 60, 70, do we think it will prosper in that environment?
Anybody that listened to you from 2010, you've done a grave disservice to them. So if you feel fine with that, that's what you do for a living. That's fine. I don't have a problem. Andrew invited you on. I'm just pointing out the facts of the situation. If someday you might be right like a broken clock. That's what we'll say. This may be a huge bubble that we're in. But you said it again and again and again and again and again and again.
Someone who takes its view from gleaning the internet.
This is your track record.
It proves you don't know what you're talking about.
You can take a moment.
I said my piece. You booked in. You've got your 1929 book out. Maybe it happens at some point. Maybe it doesn't. But hopefully it doesn't. The market at this point, the S&P is pushing 8,000 eventually, and you've probably been bearish for 80% of that of 2021. Did you ever turn bullish?
Okay. This bullshit from the internet is one thing.
But when you're working 9 to 5, headlines like this are actually opportunities to invest more. When you are early retired and living frugally on a moderate budget, less than $1 million like I am, and you rely on your portfolio fund for your daily life and your future, hearing a billionaire like this say a 70% drop is coming will make anyone's stomach turn. My immediate reaction would be pull out. Just go to cash. Protect the nest egg and wait for the opportunity to go back in. But hitting that panic button, it is the ultimate retirement trap and fail. It is the ultimate one that will just destroy you. Jeremy Grantham is what the financial world calls a perma-bear, and I think he wears that badge very proudly. His book is called The Making of a Perma-Bear. He's smart. He has famously called the dot-com crash, even though it was 5 years too early. And I don't know, maybe it's his British accent that makes him sound smarter, but I think it makes him sound more pretentious. He has been predicting imminent doom almost continuously for the last 20 years. I think he's almost as famous as Michael Burry. Michael Burry was the one-hit wonder who called the housing crash in 2009, and he's been calling for doom ever since. Even during the biggest market incline in the last decade. Remember in 2009, the great financial crisis just hit bottom. And the perma-bears like Burry and Grantham tell you that the world is ending. And if you listened to them back then and sat on the sidelines waiting for the final crash, while the markets marched on its ways to where they sit now, you didn't protect your money. You just completely destroyed your future. I hear stories of people who are still sitting on the sidelines waiting for a pullback. If you did that, you missed out on a historic 6 to 8x return on your capital in just 15 years. When the market hysterically averages only about 10% annually, that is huge. If you had a modest budget of $500,000 portfolio back then and hid it under the mattress because of a scary interview like this, you cost yourself potentially millions of dollars in some serious wealth growing just for keeping it in the market and not getting scared. Being early to call a bubble by 10 or 15 years isn't being right. It's a catastrophic investment error for an everyday retiree. Here's the irony that really drives me crazy with these guys. Jeremy Grantham is a billionaire. How did he make his millions? By founding this hedge fund, this GMO, a massive asset management firm. His firm charges management fees to manage billions of dollars inside the very stock market he publicly warns everybody to flee. Billionaires can afford to be wrong about the market for a decade because they're already billionaires. If Jeremy Grantham sits in cash and misses a massive US tech rally, his lifestyle won't change. He still will go home to his estate and his grandchildren's children are still set for life. Now, I don't have any problem with the billionaires, but I do have a problem sometimes with what they say and how they influence people. Because if you sit on the sidelines with your $500,000 because you got scared out by a cable news clip like this, you don't just lose percentage points, you lose your ability to pay your rent, to cover your medical expenses, and just to stay afloat, however many years you have remaining. You are taking all the risk of their bad predictions while they take none of the consequences. We had this exact movie just very recently in March 2020 when the pandemic hit. The world went into lockdown, and the billionaire hedge fund manager, Bill Ackman, he called into CNBC in a complete panic, and he literally told everyone hell is coming and corporate America was going to collapse. The markets puked. Everyday investors panicked and they sold at the absolute bottom and they locked in those horrible losses. And what happened later? It was revealed that while Ackman was on television sounding like the Grim Reaper, his hedge fund was unwinding a massive credit hedge, bagging $2.6 billion in that windfall on a $27 million bet. They used the cash to immediately buy up all the shares that all of you regular Joe Schmoes were selling, absolute bargain basement prices. Within 3 months, the market not only recovered, but went on to form new highs by the end of the year. Now Ackman later argues that he was just trying to warn that the government was going to go in lockdown, not tank the market. I think that's BS. I think he's just trying to cover his tail now. But the lesson for you and me is just sits right there in plain sight. Financial media is designed to create an emotional television. It's pure drama creation. It's a soap opera. The more they create these panics, the more they keep you watching. That's why I don't watch these news television shows that frequently unless something comes to my attention. They're absolute wealth killers for retirees. I've heard people say the market is a casino and designed to take your money, and I think that's partially true. If you're a gambler and you like to play it like that, it's a casino. If you're a trader, it's a casino. But if you know the game and you play the long term and buy stocks in solid companies, or safer yet, just buy ETFs, you will win with patience and close your mind completely off to the noise and the fear mongering. These hedge fund managers don't give a rip about you or your future. Here is a brutal call that I recently listened to on the Ramsey Show highlights recently. An older couple in the 60s, they called and they confessed to a textbook retirement fail that we're talking about now. They panicked during the COVID crash in 2020. They completely liquidated their only investments of $190,000 in the stock market to sit and save cash. Their plan was to wait on the sidelines until the market stabilized, then jump back in. But the market was only down for about 3 months and skyrocketed. And they stayed frozen in cash for years, waiting for a dip that never came. By trying to time the market, because the market more than doubled since 2020, they effectively lost out on $220,000 in pure missed gains. Their safety net became their wealth killer. They literally paid a 6-figure penalty just to sit in cash, all because they let a temporary market drop dictate a permanent emotional decision. When I first started investing more seriously around that time, I lost thousands because of knee-jerk reactions to this type of news and this type of people that you think that would be telling you the truth. You listen to them. Since the beginning of 2020 through the mid-2026 to where we are now, the S&P 500 is approximately 155% in gains, while the NASDAQ return has grown to 218,000. The NASDAQ has more than doubled. The S&P doubled within that 5-year period. Both indexes experienced significant gains during this period, despite the major market downturn in 2022. Year to date, the S&P 500 is up 9.9%, almost 10%, while the NASDAQ has risen approximately 9.11%. It's a little more volatile, but 10% just in 6 months. So this is the ultimate ground reality for 2026. This year has been absolutely crazy. I've only really been following the market for 6 years now, and nothing compares to what I'm saying this year, and it's only 6 months in. But here's the reality. The recent calculation for money printing is over 6%. That's why the US dollar is devaluing. US inflation has recently been reported to hovering around 3.8%. They've been trying to get inflation down to 2% for 4 years now. And personally, I don't think they will. I actually think they're going to move the goalpost to 3%. Pain required to bring inflation down to 2% will be too unbearable for the US and even global economies. I'm no economist, but that's my opinion. When inflation is nearly at 4% and sitting on cash isn't safe, sitting in cash is a financial suicide in slow motion. Your purchasing power has eroded by 4% every year So instead of the 190,000 from that couple being worth well over 300,000 now, just in 5 years, is now worth 150,000. The only historical proven way to stay ahead of the money printing machine and rampant inflation is to stay invested in strong, productive, cash flowing global companies. Companies that can raise their prices when their costs go up. Do the valuations get stressed, or maybe some of these companies are overvalued? Yeah, sure. Is there going to be some volatility and drops, an ugly correction before the end of the year? Yeah, I'm fully expecting one. But I think we're living in unprecedented times, and like the interviewer said, this time is different, and I think it is. The dot-com crash that everybody keeps referring to, those were companies that weren't even making any revenue, especially the big tech ones. They're profit makers. They're printing money like crazy. Their profit margins are not even compared to what they were like back in the year 2000. But that's why we keep short-term cash buffer or sub-accounts to ride out the storm without selling your assets. Letting a billionaire perma-bear frighten you out of equities entirely means you're unwillingly signing up for a guaranteed loss. Just don't do it. I think the bottom line is simple. Don't let these people, these with billions of dollars, scare you out of the market that make them rich in the first place. Keep your eye on your own plan. Ignore the doom and gloom of the cable news and just keep marching forward. Listen to people you trust. The second one is only keep the amount of cash that you might need to ride out the volatility in the market. For me, I'm probably only going to do about 2 years. I do think the market is going to continue to climb at least 3 to 5 years. And then the third one is just educate yourself about how the markets work. Understand this volatility. Don't let these people scare you out of your money. So if you're out there building your own retirement like I am, make sure to hit that subscribe button and give this video a thumbs up. I really appreciate it. And let me know down in the comments, have you ever let a scary financial headline like this scare you out of the market, out of an investment that you would only regret later? How do you keep the media noise from messing with your head? So this is Trace at Winding Down Chronicles, and that's this week's fail, so you don't have to make it. See you in the next one.
Okay, this bullshit from the internet is one thing.